So this next module here is dealing with a few items that would be considered new to you, I suppose, but how it relates to some of the things or loans that we've already talked about. Okay, but right here, for example, there is a difference between an open-end loan and a closed-end loan. And if you get an open-end loan, or sometimes you hear it referred to as an open-end mortgage, that's kind of like a home equity line of credit. If you remember, we said, with a home equity line, that's where you get pre-approved up to a certain amount. I think the example we used earlier was like, say you're approved for 20,000. Obviously, it's all based on the equity you have in your home. And you can just use that money over and over again, like it's a credit card, right? You can pull it out, and as you pay it back, you can pull it back out and use it again. So it's an open-end line of credit is what it is. That's why they call it an open-end loan. It doesn't go away or close out just because you paid it off. It stays open, and you can use it, pull money back out anytime you want to, as long as you don't exceed whatever you've been approved for. So, excuse me, so that's an open-end loan. Now, if you have a closed-end loan or a closed-end mortgage, that's the kind of loan that you typically get to purchase the property, okay? But with a closed-end loan, once you pay that off, it's over. You're done. The loan goes away. So if you wanted more money, you'd have to go get another loan. Okay. So open end is just a revolving line of credit, just an open end line. Closed end just means you borrow the money, you pay it back, and you're done. You can't keep using that loan. So hopefully that will make sense to you. All right, then here's something called a subprime loan. I don't even know why these are legal, to be honest with you. It kind of irritate me. But obviously, these are loans made to individuals. Basically, lender knows that they're probably not going to be able to pay this loan back. If you have a very low credit score, your debt income is high. In other words, you are high risk. You probably already owe more than you can pay back as it is, or your income is just not to where you can be able to pay it back. The lender will still maybe take the chance, but they call this a subprime loan. But I will tell you, the fees, the interest rates, everything about this loan is incredibly expensive. Which makes no sense to me. Basically the lender's saying, well, you can't afford a loan, but we'll loan you the money anyway, but we're gonna have to give you a much higher interest rate. The terms are going to be very expensive for you, and somehow, which again makes no sense to me. Lender, if you're concerned that I can't pay it back to begin with with a normal loan, what makes you think I'm going to pay it back when you add all these fees to it and increase my interest rate? How is that going to help at all? So I don't really understand how they even get away with this, but that's what they call a subprime loan. So if you got someone that really just cannot really afford a loan, they'll give you a subprime loan just to make sure you can't pay it back, I guess. But anyway, that's what a subprime is. But then you could have what they call a buy down. This is where these discount points come into play. We've already talked about discount points. We know discount points you can purchase to buy down the interest rate, right? And we remember how much a discount point costs, I hope. We know it costs 1% of the loan amount. Remember, it's important to distinguish that that 1% is based on the loan amount, not the purchase price. So be careful that they don't cause you a problem with that if they ask you anything about it. And then how much does each point drop or buy down your interest rate? Remember we said it's 1/8 of 1%. So again, each point costs 1% of the loan amount, and for however many points you buy, each point will lower the rate by 1/8 of 1%. All right. So now we need to take a look at some types of mortgages that have some very unique payment structures. Again, don't know how common these are. There's like 3 or 4 here different payment plans, I guess you could potentially consider. But again, you're not the expert. You're not supposed to know everything there is to know about this stuff, again, because you're not the lender. But just kind of understand the basics behind each one of these. But we start out with something called a graduated payment mortgage. It says that's going to be a fixed rate where your payments start out low, but gradually will increase as you go through your payment schedule. It says initially payments may not cover the entire accrued interest, leading to a negative amortization, because y'all, they start you out low. Y'all, you got a much smaller payment than you probably need to make, but over time your payment will start to increase. Okay, y'all, to me that just seems like a very risky loan. Y'all, especially if you're having a hard time making the payment to begin with. Knowing that payment's going to start getting higher and higher and higher. But y'all, the reason they say this would be a good loan is if maybe right now you can't afford to make the full payment, but you know you're getting a promotion, a job promotion, so you're going to be getting more income soon. And by the time the payments start going up or getting higher, you will already be making more money, and now you can afford it. That seems a little risky to me. So a graduated payment just means you're going to start out with low payments, and gradually that payment's going to get higher and higher, okay, to help pay off the loan. But then there's the growing equity mortgage. Says again, this is another fixed rate. Y'all, fixed rate just means your your payment stays pretty much the same. Your interest rate stays the same. But again, your payment will begin to increase. Okay. There's no negative amortization. In other words, so the interest is, you're still paying all your interest, but you still have a increased payment. It keeps going up over time. And the reason you might consider this is because it helps pay the loan off earlier. So you're paying all the interest. That's not the issue, compared to the first one, the last one we just talked about. You're not paying all the interest you owe. That's why it's so low and gradually goes up. But with growing equity, that just means you're still paying all the interest you owe, but your payments will still go up, which will pay the loan off earlier. Okay, so that's the benefit of a growing equity mortgage. You could have a pledged account mortgage. I don't really care for any of these, to be honest with you, but how does that, what is it, how does a pledged account mortgage work? It says here where the borrower will deposit funds into a savings account, which the lender will have control over. It says this account, it's used to offset or reduce initial mortgage payments. Payments start lower and increase over time as the other graduated payments do. But it says it's ideal for borrowers who expect future income growth but need lighter payments in the earlier years. But the savings account can generate interest, which also contributes to early payments. Again, I've never had a savings account that generated a whole lot of interest that was going to make that much difference, to be honest with you. But y'all, the main thing you need to understand or remember about a pledged account mortgage, it involves a savings account that you will have money in, obviously drawing interest, and that interest is being applied towards your payment. The lender has control over that savings account. Okay, so I would just remember savings account. That's a pledged account mortgage. That's what you're dealing with there. And then the last of these unique payment structures is what we call a straight line mortgage, where it says each payment is going to apply a constant amount to the principal. Each payment will reduce your principal by the same amount. Your loan balance is shrinking because you're paying off the loan, and the interest portion declines. This is kind of like a fully amortized loan, okay? But it says here too that the total payment decreases over time because of the interest getting smaller. So, in fact, we talked about it earlier. Your payment will actually get lower, smaller. You're making smaller payments over time because the interest that you're over time is getting smaller. That's all they're talking about there. So, those are, I think it was 4 very unique payment structures for mortgages.